And for more on the outlook for the U.S. economy in the days and the weeks ahead, I'm joined by Anthony Chan. He's a former chief economist at JPMorgan Chase. Anthony, always great to have you on. First of all, just want to get your reaction to CPI data for August that came out. The headline number looked good. Core, you know.
Well, Karina, I actually like the report because the headline number is very attractive, as you point out. The core number is still a bit of a stubborn and sticky number at 3.2%. But keep in mind that that headline number peaked at 9.1%. So when people talk about the fact that we have the highest inflation numbers in 40 years, I would say to them, yes, that was a couple of years ago, but now inflation is headed in the right direction. And that's the reason why on September 18th that the Federal Reserve is going to start thinking about lowering interest rates because inflation is moving closer and closer to the target.
And so what does the Federal Reserve do next week based on this data? Because as we said, core inflation on the month slightly higher, but overall we're lower. A clear softening in the labor market. Wage growth is decent. So is the Fed in any sort of urgency to cut drastically, or do they cut by 25 basis points at this point?
Well, I think, Karina, you hit the nail on the head when you talked about a little bit of concern over the core number, which is the CPI excluding food and energy. That's still a little high. So that tells me that the Fed is less likely to cut by 50 basis points because that number is still a little high. But at the same time, the headline number tells me they have the green light to cut. So I'm gonna go with 25 basis points when they meet. And then I think that they will follow that up with other 25 basis points cuts at the following meetings between now and the end of the year.
So how many cuts do you think we get from now until the end of the year then?
I think we can easily get 3 cuts between now and the end of the year. And then I think next year we could easily get 100 to 125 basis points of cuts in 2025. Again, remember that if inflation is running at 2.5%, and you have a Fed funds rate at 5.3%, it doesn't take an economist to figure out that monetary policy is somewhat restrictive. And if inflation is going down as monetary policy is restrictive, the Fed has to act.
Right. Talk to me about the strength and resilience of U.S. consumers in the face of this inflationary period many have never seen before, right? They seem to keep spending. The latest read for second quarter GDP was 3%. But who is it that's actually doing the majority of that spending? Because one camp says it's wealthier Americans as opposed to lower income families. And how long can they keep spending?
Well, I think they can continue to spend for quite some time because consumer balance sheets are healthy. They're not over leveraged. But you are correct that super low income cohort is struggling. You're seeing delinquency rates picking up. You're starting to see that they are a bit stretched. But by and large, the consumer, excluding that low income cohort, is doing pretty well. So it's the middle income and the upper income. You saw that in the Walmart numbers. But that super low income, you saw that in the Dollar General numbers and the Dollar Tree numbers. They are stressed. But remember, the majority of consumer spending comes into that higher income category, middle income to higher income category. And that's why consumer spending is going to continue to go on. And that's why I think that the odds of any collapse or anything resembling a recession over the next couple of months is off the table.
Well, that was going to be my next question, because do you foresee a recession in the U.S.? And then how does the U.S. compare economically, to the rest of the world? How much of a better shape are we in than some other countries?
I think that right now we're in pretty good shape because, first of all, we have a lot of room to lower interest rates. We've already seen mortgage rates come back down significantly. And as you continue to see more Federal Reserve cuts, you're going to see that mortgage rate come down. That's going to help not only the housing sector, but it's also going to help the other interest-sensitive sectors like automobiles, which are suffering from high inventories in many instances. So that is going to give another push to the overall economy. But right now, I say that the consumer is still holding on and doing quite well.
Yeah, I'd really like to see shelter costs come down. I think a lot of people would like to see that happen. I want to move on and ask you, Anthony, if elected, Trump has promised higher taxes on imports, especially on countries moving away from the dollar. So how would more import tariffs and potential trade wars impact our economy and the global economy?
Well, I think that there's a consensus view out there for most economists that any increases in tariffs get passed on to the consumer. I know that you hear otherwise, but if you look at the evidence out there, and many studies out there, nonpartisan studies have shown that it is virtually one for one, or more than 95% of all those tariffs are passed on to the consumer. So what does that mean? That means that consumers will have to pay more. Inflation will also pick up a lot more. And then, of course, we're not even talking about the tax plans of both candidates that are completely or somewhat different from each other, but the tariffs themselves will be inflationary. And by the way, not only will they be inflationary, but they'll slow down economic growth because countries around the world will retaliate. No country out there is just going to take higher tariffs and not do anything about it. You're seeing that already when Europe was talking about increasing tariffs against China. You saw that about when Canada was thinking about tariffs. So any country that tries to restrict trade or increase tariffs is going to be met with retaliatory moves from the other countries. And guess what? That tends to slow economic growth, and the tariffs themselves tend to increase inflation.